Thanks for joining me for this midweek reporting season video in our fourth week of the reporting season period for February 2025. I'm Grady market analyst with Bell Direct, and what a reporting season this is shaping out to be. So far, we've seen 174 companies release results, with 61 beating expectations, while 62 met expectations and 51 missed expectations. To the upside, 28 companies have been upgraded, while 33 have been downgraded by brokers. So let's dive into the companies in focus today. Domino's Pizza disappointed investors yesterday, with most metrics sliding in the first half amid cost pressures following the closure of 205 loss-making stores. For the first half, Domino's reported network sales fell 2.9% on the prior corresponding period, network store count declined 2.6%, EBITDA fell 3.9%, EBIT declined 6.7%, EPS shed 8% to 64.1 cents per share. But in good news for investors, the company maintained its interim dividend of 55.5 cents per share, and that's up on the second half of FY24. Domino's slipped into the red in profit and loss terms, with the company posting a $22.17 million loss for the first half. However, this was weighed down by $115.6 million in non-recurring significant charges related to the loss-making store closures in the first half. Without the significant one-off items, DMP made an underlying profit before tax from continuing operations of $85.6 million. The outlook, though, is stronger after closing 205 loss-making stores and implementing cost-saving measures to the total of $34 million annually, according to the company. Australian operations showed a 7.6% EBIT increase, though, to $67.7 million, while France and Japan struggled, mostly due to those store closures. A positive note was a 13.7% rise in franchisee profitability to $96,400 in EBITDA over the 12 months, highlighting the company's need for further savings in sales. DMP shares dropped more than 10% when the results were released, and the question now lies, can new Managing Director and CEO Mark van Dijk return the once market darling to profitable growth in the near term? Elsewhere, John's Lyng Group shares dived over 33% upon release of results on Tuesday. The building and restoration company and services provider across Australia and the US faced a very challenging first half operating environment, especially in Australia with benign weather conditions reducing the volume of insurance claims, while the US had project commencement delays impacting performance in the first half. For the first half, revenue for business as usual operations, or BAU, totaled $573.1 million, while EBITDA came in at $54.2 million. While a stronger second half is expected, supported by active peak surge in weather events, according to the company, JLG narrowed its revenue and EBITDA guidance ranges for the full year by 5% and 4.5% respectively. Now elsewhere, 2024 market darling Zipco proved its worth, going from strength to strength with posting record first half results out yesterday, sending shares in the buy now pay later company up at 13.5% or over 14% by the end of the session. For the first half, the buy now pay later provider reported double-digit growth across most metrics, which is incredible, with cash earnings up 117% to a record $67 million. Total transaction value rose 23.9% to $6.2 billion. Total income rose 19.8% to $514 million. Cash gross profit climbed 30.1% to $235.5 million. And net bad debts were down 1.6% of total transaction value. So the lower that is, the better. On the slight downside, revenue margin decreased to 8.2% from 8.5% in the prior corresponding period, but compared to the results, that's only a slight downside there. Management attributed the solid results to outstanding growth in the US, where the company reported total transaction value increased 40.3% in the half to $2.9 billion US. The outlook is bright for Zip too, with the firm launching Zip Plus to new customers, and Zip Personal Loans was also launched in January this year. The company expanding Zip's total personal financial solutions portfolio to cover every area of our life. On the outlook front, Zip reaffirmed guidance set last August upon release of FY24 full-year results, which is assuring to investors. With a total addressable market of $12.3 trillion in the US payments market and $2 trillion in the home loans market, Zip has significant headroom for continued growth in market share. And energy giant Woodside reported full-year results for FY24 this week, with NPAT more than doubling for the full year, up 115% to $3.573 billion, but underlying profits slid 13% due primarily to lower realised oil and gas prices. Over the last year, Woodside has had excellent operational output with record production of 193.9 million barrels of oil equivalent, or MMBOE, which was underpinned by outstanding early production performance at Sangomar, Woodside's latest oil and gas field offshore in Senegal. Stringent cost management also saw Woodside reduce unit cost of production per barrel of oil equivalent by 2% to $8.10 per barrel of oil equivalent, while operating cash flow was strong at $5.8 billion. The energy giant also enters FY25 with major project updates, including the Scarborough Energy Project, now 80% complete and on track for first LNG cargo in 2026. On the downside of the results, operating revenue fell 6% on the PCP, and the full-year dividends fell 13% on 2023. Upon release of the results, Woodside shares rose 2.75%. Elsewhere, among other companies that have released results in recent days, investors sent shares in Nine Entertainment Co. up 4.7%, Sims up 1.5%, and Ingenia Communities up 2.1% on strong first half results. While shares in Reece, the plumbing parts giant, fell 3.7%, Block lost 3.8%, and Viva Energy tumbled over 25% on release of their respective results. Thanks for joining me for this final midweek video this reporting season for February 2025. Be sure to tune in for our final reporting season wrap soon. Happy Wednesday and happy investing.